Welcome to the third episode of our On Air with Funded series. My name is Johan Terblanche. I'm the managing partner of our Luxembourg office, where I'm also head of the funds and investment management team. I'm joined by my finance partner, Arnaud Arrecgros, who also practices in our Luxembourg office. We see an ever-increasing number of new fund launches in Luxembourg. What are you seeing in the funds finance market?
As anticipated, the market has been very active through the second and third quarters of the year, keeping our fund finance specialists very busy. We have seen a material increase in the volumes. We did not see signs of significant slowdowns over the summer period, and the pipeline is already filling up for the year-end period, which has always been a busy part of the year for us. While we are seeing new subscription lines being set up alongside the usual accessions and extensions, the past few months have shown a technical diversification in the field, with a growing number of hybrid and tailor-made financing arrangements, co-investment lines, and a surge in NAV facilities. I do not think this will come as a surprise to most, as it had been anticipated by the industry.
We've noticed increases in financing arrangements across the funds we advise to, and have also noticed a wider variety of financing arrangements than what used to be the case, including in closed-ended drawdown funds. Do you know what's driving this development?
I believe there are several reasons to explain the increased number of NAV facility deals. First and foremost, there is the current business environment, the increase in prices that led some managers to question the cost of sublines, less favorable fundraising conditions which lead to longer fundraisers, the challenging general market conditions that may discourage the sale of assets and require follow-on investments after the subline is exhausted, leaving GPs in need of new types of financing that accommodate longer investment period strategies. On top of that, managers have become increasingly familiar with NAV facility arrangements and are now more comfortable to make adequate use of these to implement their portfolio management and investment strategies.
It seems to me that the mechanics and architecture of the respective funds and their circumstances and specific needs at the relevant time, rather than the investment strategy, are the primary drivers for the use of the various types of financing. And we've also noticed that not all lenders are used across the board, and some seem to be favored for specific types of financing. Have you noticed changes in the sources of the financing?
We are definitely seeing a diversification in the lenders pool, with new participants, such as regional banks, increasing their market share in the field. The liquidity squeeze that affected the traditional credit institutions and results from a variety of factors, notably capital constraints and regulatory framework, is definitely one of the causes, as it forces the managers to seek capital from non-bank or traditional credit institutions. Beyond these constraints, this trend is also encouraged by managers' appetite to establish several relationships across the fund groups with more than just one lender, so as to address concerns pertaining to the certain US bank's failure earlier in the year for the sake of greater agility in case a similar scenario occurs again. The foregoing context has led to more attention being paid to particular provisions of the finance documents in the course of their negotiation. As an example, lenders will now often be more reluctant, absent actual limitations resulting from the fund documents, to limit their ability, following the occurrence of a default, to direct payment of unfunded commitments to bank accounts other than the pledged collateral account opened in the name of the pledgor. Borrowers will similarly make sure that the conditions subject to which the collateral account may be transferred to a succeeding account bank or depository are not unreasonably or unnecessarily constrained.
In our funds practice, we continue to see a significant increase in funds that encompass multiple different vehicles, often a combination of Delaware, Cayman Islands, Jersey, and Luxembourg or Irish parallel funds, which sometimes invest via lower-tier pooling vehicles. Do these structures present additional challenges when it comes to financing?
Yes, these structures can result in added complexity in some instances. For example, where foreign non-Luxembourg funds are interposed between Luxembourg funds, and where various considerations, the exact nature of which will depend on the jurisdictions where the funds or the limited partners are located, but a common issue pertains to ERISA-linked constraints, will require any security package granted to third-party lenders to be cascading. We have seen this happening quite a few times over the past month, and it would be wise to anticipate these topics early in the fund formation process, especially where the value of the commitment at the level of the top Lux fund is material and definitely expected to form part of the borrowing base.
If we can look into the crystal ball for a moment, it seems to me that the larger and more complex fund offerings, which appeal to a wide range of potential investors, are here to stay. and that the considerations we discussed will remain prevalent for the foreseeable future. Do you feel the same way? And would you venture a guess as to how things are likely to develop over the short and medium term?
I totally agree. I believe the fund finance landscape is moving positively into a phase that will present a much broader range of solutions, customized to the participants' specific needs and expectations, both on the lending and borrowing side. I think these new entrants, such as regional credit institutions and non-bank lenders, in particular debt funds and insurance companies, are meant to stay and help satisfy the liquidity demand. I also think that market participants seem more keen to seize the various types of financing arrangements available to them, according to their specific needs and the circumstances, be it traditional subscription facilities, NAV facilities, and tailor-made arrangements, such as hybrid and co-investment lines.
If you have any questions on Luxembourg investment funds, regulation, or our European offering, please feel free to reach out to me or another member of our Luxembourg funds team.